Hello, and welcome to Your Estate Matters with your hosts, my colleague Greg Bernand and myself, Nicole Garten of Heritage Trust.
Your Estate Matters is a podcast dedicated to everything estates, including building and preserving your legacy.
If it's estate related, we'll be talking about it. We're having the conversations today that will help Canadians protect their families, their assets, and their legacies tomorrow. Areet, thank you so much for being here with us today. And would you like to tell us about your journey to becoming a partner at Legacy?
Absolutely. So I started my career in tax about 15 years ago. And I started at a regional a business tax firm, full service firm. And as an articling student, you're kind of thrown into all areas of the law and you get exposed to a lot of different things. And I found I really liked so many different things. And I found a lot of areas of law very interesting. And what I liked about tax at the time was it kind of touched everything else. Every individual, every business, every industry, tax is relevant for everything that goes on. And so that was very appealing to me. And I also liked that it was challenging and complicated and changing all the time. It never got boring, which is probably the worst thing about the area of law, but also something that keeps it interesting. And so I'm still practicing exclusively in the tax area and now at Legacy Tax and Trusts, which is a boutique tax firm that focuses on tax planning, estate planning, cross-border planning, and tax and estate litigation.
So going from the big idea of legacy, but down to your own practice, what's your general approach to personal and corporate tax matters?
Yeah, so I deal, with a range of tax matters that come up for individuals and private companies and estates and trusts. And in my practice, I deal a lot with business succession planning, family succession planning, that kind of intergenerational transfer of wealth and assets. And I think in that area, really in all areas of tax planning, but especially in that area, starting with an understanding of the client's priorities and goals is really the most important thing. So knowing, is tax minimization above all else important to them? Or do they want to make sure that their structure is as simple as possible going forward? Are they looking to leave a legacy for their children, or is that not as much of a priority? Do they want to transfer control and ownership and responsibility to the next generation sooner rather than later? Or is kind of keeping that control to themselves during their lifetime very important? So really having a feel for all of that, because there's definitely not a one-size-fits-all type of tax plan. And so having a good understanding of those priorities really can help make sure that you come up with the best tax plan.
So what about families that have cross-border issues or international assets? How do you approach that?
Yeah, so this comes up a lot, and I think maybe part of it is just the way we live these days. A cross-border element comes up in so many tax planning files. Canadians that have interests and assets in other countries, or children living in other countries, or vice versa. Foreign individuals, non-residents that have property in Canada, children here, businesses here. And so I think that the first thing that's really important is just understanding what is where and how those assets are owned, which sounds simple, but when it's a complicated structure, sometimes just getting a lay of the land and really having a clear picture of everything can sometimes be challenging. And, in terms of my approach, I think on those types of files, it's really critical to know and be connected to the advisors in other jurisdictions, because you can come up with a plan that works from a Canadian perspective, and it might create all of these, consequences in another jurisdiction that you're just not aware of, and vice versa. So kind of having communication between all the advisors is very important.
So how do tax treaties impact the overall tax pictures for individuals moving between Canada and treaty countries?
Yeah, so treaties can have a big impact on the overall tax landscape. I guess how important they are depends a bit on the specific facts and kind of the asset mix. But often they come up in a couple of different ways. One is with Canadian withholding rates that comes up regularly. So if you have somebody who is departing Canada, but they're continuing to earn Canadian source income, they would be subject to Canadian withholding. And our default rate is 25%, but most of our treaties reduce that quite a bit. So, for example, somebody leaves Canada and they have an interest in a Canadian company and they receive dividends through that company. Instead of the 25% default rate, it might be 15% or even 5%. And that can have a significant impact especially where the dividend income is maybe a major source of income for that individual going forward. And the other way that tax treaties can really have a big impact is kind of dealing with the issues around double taxation. Because if you're a resident of Canada and you're also subject to tax in another jurisdiction, for example, as a citizen of the U.S., which is the scenario that comes up a lot here, you're subject to tax in both countries. And you can be taxed on the same asset and the same income stream. So the treaty has different provisions that kind of help with that double tax situation. And also to help with the timing mismatch that can sometimes come up because you might be subject to tax in Canada at a certain time, possibly because of some sort of deeming event that arises under our tax rules, but there may not be an equivalent under the U.S. rules. So you don't get a step up in cost basis. You maybe don't have the ability to use foreign tax credits. So that can create issues. So for people that are subject to tax in more than one jurisdiction, the treaty can be very advantageous.
So we're in an environment of a lot of uncertainty. There were potential tariff threats. We've got to pause. Some Canadians might be thinking about emigrating from Canada if it makes sense for their business. Can you talk to us about departure tax and what is some planning Canadians can do to reduce what that might be?
Yeah, so when somebody departs Canada, the big tax consideration is the departure tax that you mentioned, and essentially that's a deeming rule that provides that for Canadian tax purposes, it's as if you sold most of your assets immediately before you left the country for fair market value at the time. And the reason for this rule is to ensure that Canada can tax you on the increase in the value of your assets that accrued during your time as a resident of Canada. And of course, there are certain exceptions to this rule. So the one that comes up often is real estate in Canada. If you continue to own properties here, it's not going to be the ownership of that asset is not subject to departure tax. And the reason for that is because Canada is always going to have a continued right and ability to tax real estate in Canada. And we have mechanisms kind of built into our tax rules that will make sure that when you do sell that asset in the future, even though you're a non-resident, there's an ability to collect tax at that time.
Is that the Section 116 certificate?
Yes.
Okay.
Yes.
Do you want to tell the listeners what that is?
Yeah. So Section 116 is a provision that requires a purchaser of real estate who's buying property from a non-resident to withhold and remit a certain portion of the purchase price to CRA on account of the non-resident's tax liability. And that's really the mechanism that ensures that when a non-resident sells real estate, the government is going to get their share of the tax that they're owed. And so with the departure planning, there's really the first step is kind of figuring out what are your assets, what are their values at the time of your departure, and what is your exposure for departure tax. And then there are different strategies and ways of potentially minimizing or mitigating the tax depending on the type of assets that you have. And the other part of the planning is really looking at what assets are you continuing to have in Canada, and does it still make sense to have these assets or to have the structure that you have in Canada, and kind of working through the effective tax rate once you become a non-resident, and looking at what the compliance is going to look like to figure out if there's any planning you should do before you depart, to kind of make things better for you once you're a non-resident.
What about registered assets like RSPs and TFSAs? What do people do with those?
So RSPs and TFSAs would be assets that are not subject to the departure tax. So there's no immediate tax liability associated with having that asset. Once you depart, to the extent you make a withdrawal as a non-resident, there is withholding that applies to that withdrawal. And again, that's where treaties can be relevant, because the withholding rate may be reduced under a treaty. But once you are a non-resident, there's also no more contribution room, and there can be significant penalties if you tried to add to your RSP once you depart. With TFSAs, there's no withholding that applies to future withdrawals, but there is a similar penalty if you tried to contribute further to your TFSA after you departed. And then there's also the question of, maybe those types of assets still make sense from a Canadian perspective when you work through the rules, but looking at in your new jurisdiction, how will that asset be taxed? And for example, TFSAs in the US are not taxed the same way. So generally, we would recommend someone with a TFSA moving to the US to maybe wind that up before they do.
Now, what are the main considerations tax-wise for Canadians that are returning home after having lived abroad for a number of years?
Yeah, so when you come back to Canada, it's almost kind of the reverse planning in some ways, because now in whatever country you were living in, they may have their own version of the departure tax or exit tax. So kind of working through what that looks like, and then looking at the assets you've accumulated while you were a non-resident, the structures that you have, and whether those are still going to make sense for you once you become a resident of Canada again. For example, if you are in the US and you set up an LLC, that's generally not going to be a tax-effective vehicle for a Canadian resident. So you'd probably look to kind of winding that up or restructuring before you come to Canada. And then for Canadian purposes, we again have that same type of deeming rule. So you're deemed to dispose of your assets and reacquire them at fair market value immediately before you come to Canada or return to Canada. And this time it doesn't cause any tax to be payable. It really just resets your cost base to ensure that you are only now subject to tax in Canada based on the value that accrues after you resume residency. But it is important to ensure you have a record of the value of your assets at the time that you become a resident again, because that is now going to be your cost base going forward.
So what are some interesting immigration and immigration issues you see in your practice?
Well, 2024 was kind of an interesting year because, as you know, our government proposed to change the capital gains inclusion rate as of June 24th, 2024. And so there was a lot of planning being done to crystallize capital gains in advance of that date. And of course, the inclusion rate is also, very relevant if you're departing Canada. So we did see a lot of clients that already had plans in the works to depart, and they, had had estimated departure tax exposure to be of a certain value, and all of a sudden that may have changed dramatically. So people looking to kind of accelerate their move date. So a lot of planning happening quite quickly, and that had quite a bit of challenge associated with it. Even just obtaining valuations quickly can be hard, especially where there's foreign assets and you're trying to coordinate evaluations of shares in different companies or property in different countries or property in different countries. So that was quite an interesting time. The other thing that's interesting that we haven't really talked about yet, that I think is maybe coming up more and more is kind of just the concept of residency. Because of course, when you immigrate out of the country or return and resume residency, it's all dependent on, when you become a resident for tax purposes or when you cease to be a resident for tax purposes. And in most cases, that's really obvious when that happens because you have an intention to move or you have an intention to come to Canada. But we do have more and more scenarios where it isn't obvious. You have a strong connection to more than one jurisdiction, especially kind of in this post-COVID world where you're maybe living one place and working for an entity in another jurisdiction and traveling between and, family and business interests in multiple places. And so we have seen some situations where people come to Canada and they don't consider themselves resident for tax purposes, but based on our test for residency, which is really just based on, your ties to the country, your connection to the country, they actually are resident. And that can be quite a mess when you didn't anticipate that, especially where that same person might control a company and there may be implications for the company because of their residency change, or they may be the trustee of a family trust. And now there's a question around, did the residents of this trust also change? So when that's kind of not thought through and it happens without planning, it can create some interesting situations and some complexity.
So who's leaving Canada? I think our concern is that because of our tax regime, that we're losing high-earning professionals and physicians and things like that. Are you seeing that in your practice?
Yes. Yeah, I definitely do see some of that, but then there's also the reverse. Like we do see people from the U.S. coming to Canada that are, high net worth individuals and deciding to settle in Canada for various reasons. And, maybe with the current environment in the US, we might see more of that. Who knows?
So there's not this vacuum of highly skilled professionals, I think, that we're concerned about losing.
No, I wouldn't say that. Yeah.
That's good.
Areet, would you have any final tips for the listeners?
I think I probably already made this point, but obviously kind of planning in advance for any type of departure or when you're coming to Canada, and really doing your research to understand like what does the tax landscape look like, especially for people coming to Canada, because we do have a very high tax rate environment and it can be surprising. So figuring out, what things are going to look like in your new jurisdiction, ensuring that you're connected with the proper tax advisors in both places, so that you can get the best advice and ensure that there's no surprises once you make your move.
Great. So how can our listeners find you to learn more?
Our website is legacylawyers.com, and my contact information is on our website, including my email address and my phone number. And I'm also on LinkedIn.
Great. Thank you so much.
Thank you, Areet.
Thanks for having me.
This podcast is for informational purposes only and should not be considered individual legal, financial, or tax advice. Make sure to consult the advisor of your choice to advise you on your own circumstances. Thank you for joining us for this episode of Your Estate Matters. If you like this podcast, make sure to follow it on your podcast platform of choice.
Whether you are planning your own estate or you're acting as executor for somebody else's, Heritage Trust can help. Partner with Heritage Trust to protect your family, your assets, and your legacy.
If you would like more information about Heritage Trust, please visit our website at heritagetrustcompany.ca.
This podcast is produced by Podfather Creative.